In a world first, in this particular industry, we go inside and have a good look at the full operations of one of London's prime of prime brokerages. The curtailment of counterparty credit has been a big problem for many retail brokerages, not even their liquidity partners, but the retail brokerages, because they might not necessarily know, some of the smaller ones might not necessarily know that there's been any such curtailment of counterparty credit because they don't deal with that. They will go to the prime of prime for that. Prime of prime, we've seen a few examples of this where there was one or two prime brokerage relationships with prime of prime and they've taken banks taken away.
Yes.
And then the prime of prime doesn't actually make any noise about it. It's not part of the regulatory remit, which I find extremely bizarre. I actually went to SciSec about it and asked them why don't they actually have a look at who really is a prime and who isn't, and they had no idea what I was talking about. It's not part of the regulatory remit at all. So therefore a broker partner wouldn't necessarily know they were being VBIC themselves.
True.
So, I mean, look, I think there are a few points there, but the finance is, as a business, by its very nature, cyclical, and so the counterparty credit appetite from of the major credit providers or the major PBs in the market is always going to ebb and flow. So to a certain extent, we've gone through a period of time where their appetite has reduced, and you could probably make a case that that's been beneficial to entities like us who have been who are at the more institutional end of the spectrum, if you like. I mean, I think what is a true prime of prime? What is a PB? What is an institutional broker is not really a distinction, or the various distinctions is not something that's really that well understood in the market. And ultimately, a lot of retail brokers, which is one of the larger, obviously, target client bases of our sort of business, largely a lot of those guys, often they just want to do a trade and they just want to see that trade transacted, and so they don't always necessarily think too carefully about how the trade's getting transacted, who their counterparty is, what their counterparty is doing with the risk that they take on, etc. And obviously that's naturally that individual company's prerogative, but I would share your surprise that it's not something that's necessarily that well understood within the market. I think another dynamic is that there is a certain view that there is a hierarchy of service which starts at institutional bank PB, then sort of prime of prime, so our tier of the market, and then guys who are white labeling prime of prime, so I suppose an institutional broker. But I think it's quite an important distinction to make that it's not necessarily the case that a tier one PB is going to be the right the right partner for every single firm. A retail broker who's transacting $2 or $3 billion a month doesn't need a tier one PB. What they need is someone like us who operates as a one-stop shop, as an execution specialist, and who can use the benefit of the scale that we have with the street to provide very competitive pricing to that retail broker. So previously there definitely was the case that a retail broker was sort of aspiring, or many retail brokers were aspiring, so to speak, to get a tier one PB, and it's not always the best solution for us, because actually what a tier one PB provides is materially different to what someone like us is able to provide.
In this particular sector, especially in London, the sales division of an institutional company is the link between the institutional world and the retail world.
That we pride ourselves on is working very, very closely with clients on a day-to-day basis and providing a very, very high touch service. So it's really about kind of knowing your customer in detail and actually getting an understanding of how they want to be serviced, how they can better service their clients, and really kind of taking as much of the weight off them as possible.
Alex Lowe, a hedge fund veteran, is managing director of ISAM, which was founded by Lord Stanley Fink here in London. Both Johnny Brewer and Raj Sitlani come from a very, very good quality background, actually.
Right, exactly.
You know, they had spent quite significant period of time at senior level at Sutton Financial, which is one of one of London's most prominent non-bank prime of primes, or liquidity providers, whichever way it wants to be described. But that must have stood them both in quite good stead to be able to work closely with a hedge fund and also understand the technological and actual risk management and brokerage requirements of retail brokerages.
I think that's exactly right. I think also their previous training at Goldman's has stood them in possibly even better stead.
For prime brokerage relationships.
Exactly. They really understood the prime brokerage relationship, from that work experience. I think
makes sense indeed, and it's a fascinating thing, because now with the difficulty that's been experienced, I've noticed that the banks now are starting to come back towards the OTC world, because they were curtailing credit to counterparties over the last year and a half. I would say it's been very hard to get a counterparty credit relationship if you're an OTC brokerage. Now they realise it's a very large piece of their business, and they're not able to innovate quickly themselves enough to provide their own OTC system. So they're reliant on the OTC institutional division of the OTC world, such as Prime of Primes, and also companies like XTX Markets and Citadel Securities, non-bank ECNs. So I think that's something which has started to happen, but the due diligence and they are at a tug of war where they want to start providing this business again, but the due diligence and the difficulty of getting it past the risk management aspect is hard. Whereas with a capital base like this and the modernity of this particular company, this must stand IS Prime in a good position to be able to offer not just spot FX, but various other asset classes without having any difficulties going to the bank to actually maintain those relationships that are vital to the core of a prime brokerage business.
Well, we think so. We hope so. Look, it's definitely true that banks' risk appetite is beginning to increase, but it is also true that is within a governance construct that is quite materially different to the one that was 10 years ago.
That's right.
And so yes, there are material questions that need to be answered at the level of due diligence that has to be dealt with, and there's no doubt that experience, balance sheet, assets, all of those things, and yes, relationships. We have very long, solid relationships with our prime broker, and that stands us in very good stead.
We were talking to Alex Lowe earlier. It's relatively unique that a hedge fund, which has got a technologically advanced proprietary system, is now actually has a synergy and ownership of a prime of prime. That's relatively unique. So what's it been like over the last 2 years?
It's been very exciting. At the very outset, one of the big drivers for Johnny and myself was to be aligned or within a construct where technology and quant type trading were at the forefront. And I think within a systematic hedge fund, then you end up getting really good tech and really good people. And we always maintained that that's the way forward in this business. So I think and over the last 2.5, nearly 3 years, we've just enjoyed the ride, because we are surrounded by people and bits of technology that can help us do the business that we want to build. And it is what has enabled us to differentiate ourselves in the market.
And you can connect this specific liquidity and technology to proprietary platforms of brokerages, or help them integrate with the proprietary platform.
Absolutely.
As well as MT4.
Yeah.
Yes, because I think in Britain specifically, the elite companies here on the retail side are really using bespoke platforms.
Yeah.
Largely because of the CFD aspect of British business, but also because it differentiates them from the also ran MT4 smaller brokerages all over in less populous jurisdictions, less financially well recognised jurisdictions.
Yeah.
So
I wouldn't necessarily say also ran though for MT4, because it is, I think we all know in the industry it's an industry standard product. However old the technology is, and however quirky it might be, there's still a lot of brokers out there on it. So
the vast majority, and even ones with a proprietary platform, are still offering it because of the EA compatibility, and also the ease of onboarding clients from other brokerages.
Exactly right. So I think that's the driver. It's the fact that they're trying to move people across MT4, so it's a lot easier.
Makes perfect sense.
Andrew is an expert in how trades are sent to tier 1 banks and non-bank market makers.
I don't know if you saw, but last week it was XTX launched a new zero hold time.
Yes.
So this is quite clearly they've managed to get some business because of the curtailing of credit to OTC firms from banks. This is quite clearly an attempt to try and get some of the bank business.
Yeah, I think it's the way the industry is going, and I think it's quite smart of them to jump ahead.
I think it's a good thing.
Yeah, and if they can offer pricing that is the same or better than the banks that will have a last look,
yes.
As long as the fill ratio, and I say the US dollar cost to rejection is a big metric really for us. If that's there and if that holds, then absolutely they'll be a fantastic LP.
I agree. I went to Barclays Bank recently and asked them about why the BARX platform is majoring on last look. It's not just a proponent, it's majoring on last look. It's one of the most high level proponents of that in the world. And it's one of the biggest FX dealers in the world.
Yeah.
Their response was actually that it mitigates incorrect pricing. But then again, and they've stuck to it, but now you have XTX coming in with zero hold time to try and force the whole industry to stop this practice.
Yeah, I can see where there are small levels and a small number of millies that is useful for the LP to be able to credit check or to be able to make sure they're not hit in Tokyo and New York, London all at the same time. Mind you, probably need longer than a couple of millies for that. I can see and I can understand a few millies. I can understand why that is necessary from a technology point of view. From a business point of view, it shouldn't be there. From a technology point of view, I can understand why it's there.
Yeah.
I think it's just important to be able to measure it and to be able to make sure that we know exactly what they're doing, how they're doing it, and how it's affecting our execution.
I agree with you.
And as long as you go in with your eyes open and you know what's doing, and you can have sensible discussions with the LPs on what's happening, and tune it to your liking, then I think it's possible to get a great combination of last look liquidity with a very small last look that's very good and very competitive, and no last look liquidity as well.
Yeah, absolutely. Very nice to speak to you, Andrew.
Great.
Thanks a lot. See you soon.
Cheers.
All the
Thank
best. Here we are at 55 Baker Street in the heart of the West End. Not the norm for an OTC brokerage or its prime of prime counterpart. I know that, for example, Royal Bank of Scotland, RBS now, their NatWest Markets, the investment banking side of RBS, is starting to hold its hand out more to the OTC world now. And I know a few relatively recently established prime of prime, well, not really prime liquidity providers in London that have got them as a supplier, and the deal's been done. But the rigorous due diligence was they went through everything.
Yeah.
Whereas, and it might not come to any conclusion at the end, and that's just for spot FX, not for anything else. Absolutely. And now I think that the tide has turned where a retail firm at the end has to offer a wide variety of asset classes because its customers are more sophisticated than they ever used to be. Plus, their own stability of their own businesses depends on having different asset classes, because we saw what happened on January 2015 when many spot FX firms got exposed to negative balances and couldn't pay their liquidity providers off. So they need to have some kind of risk diversity, in my opinion.
That's all of that's true, and what does that do? That just increases the barriers to entry.
It does. Yes,
within the industry, and that's a function and a factor. I mean, our prime broker SocGen, we've had a very long relationship with them through their period. They were known as New Edge, and were predominant in the CTA industry. So that sort of relationship, level of understanding, not necessarily just in terms of personalities, but the structures, the understanding of how the firm is run, how the governance structure works, how money moves, the controls around that and those sort of things do give you quite a lot of help in that process. And that is not to say that we don't spend a ferocious quantity of time being due diligenced by people that already know us pretty well, but that's as it should be.
Alongside Jonathan Brewer, Raj co-founded IS Prime when Lord Stanley Fink's hedge fund ISAP saw synergy in entering the FX prime brokerage sector. It's what's surprising, and I think a lot of this goes under the carpet. There are over 100 FCA regulated companies in this country that have got a license to deal FX on a retail basis. Most of the vast majority of people, whether it's in the industry or outside, think of 4 or 5. You think of IG Group, Hargreaves Lansdowne for the CFD business, which is an IG white label.
Yeah.
You think
CMC.
of CMC markets, which is
Yeah.
dominant here. You think of ETX.
Yeah.
That's, you know,
There really are only a handful,
A handful.
of household names.
there are
shall we
handful
say.
of exactly household names,
Yeah.
but there are over 100 actual FX brokerages regulated here.
Yeah.
So to be able to have a risk analytics platform, a genuine prime of prime, and some level of distinction in terms of being part of a large hedge fund that's well known, this would probably, would you go after some of those smaller British firms that haven't got any promise, help them build their businesses up?
It hasn't occurred to us to do so. I think, and that's really because our product is very high quality. We consider it to be one of the best out there, and that just comes with an associated cost. And so therefore, there are many brokers out there to whom we could potentially become an LP, but we have chosen not to because they probably just couldn't afford us, and that's not wishing to sound arrogant, but we think we have a premium product, and so therefore people have to be doing a certain amount of volume or a certain amount of turnover, and it has to be commercially interesting. We will on occasion look at startup brokers, particularly if or smaller brokers if they are individuals known to us from other places, because as we know, people move around, they work in one place, they learn their trade, and then they set up elsewhere. If it's someone that we think has got a track record, we're bound to be there at the start, because it would be foolish not to. And I would say that probably amongst our top 3-4 clients, every single one of them started out as a very small broker, and had we not invested the time in them, then they wouldn't be where they were now. So we wouldn't say no, but we wouldn't want to blanket market ourselves into the UK for every broker that was out there.
I see. So it's more of an international focus, but a very high level international focus.
Yeah, absolutely.
That replicates itself in the recently established Hong Kong operations,
Yep.
from which I met Will
Okay.
recently in mainland China,
Mhm.
and it looks like IS Prime is looking towards really going quite to the same level, but in the APAC.
Absolutely, it's a massive opportunity. It's also fraught with danger. Reputationally, given our association with ISAM, we felt it was imperative to seek regulation in the Hong Kong market to go for ISSP license, and that is now underway. Hopefully, one never knows with the regulator, but hopefully it will be done by the end of the year. But in the interim, we're hiring people, trying to build up the office, get everything in place for the ultimate go live in Hong Kong. And we have relationships from London into that region as well. Our experience tells us that 95% plus of the brokers out there are B-book brokers.
Yes, they are.
And 95% of the volume is B-book flow.
Right.
So the A-book opportunity is pretty small. But we saw this, I think, in the more mature markets 7-8 years ago. Everyone thought B-book was the holy grail, and over time they'll realize that B-book is not the holy grail, particularly if they don't know how to best B-book, how to do their A-book, B-book selection, and so on and so forth. And so therefore, again, with ISRA in the background, it's another massive opportunity for us to actually nurture these brokers, educate the brokers, and explain to them the market dynamics and how they ought to think about their client selection and monetizing the flow that they're on the receiving end of. We would ideally love all clients to be STP brokers and just do loads and loads of volume, but smaller broker clients will inevitably want to do B-booking, and so why let them B-book elsewhere, or why let them use other people's B-book services if we can help them within the group on that flow.
Jonathan Brewer is a managing partner of IS Prime, having founded the company alongside former colleague Raj Sitlani. Nowadays, diversity of product range is vital, not just from a risk management point of view, but also retail brokerages want it. Because they are also more sophisticated. Gone are the days in the mid-2000s, last decade, where you had an MT4 white label guy and he would just quickly take the customer's deposits and then go after 2 years. Now they've gone through so many maturity periods to the point where even an MT4 brokerage, which is a decent one, not as described, but a good quality MT4 brokerage now is aware of the risks of just doing spot FX. So they need to be able to leverage less liquid assets and be able to offer them, as well as keep up with demands in places like Hong Kong, where bullion is traded, or different marketplaces, or into mainland China, where now we've seen I was with Will in China just a few months ago in Shanghai.
Yes.
And what's happening in the south of China, we went down to Guangzhou after that, in the south, which is like the second largest financial centre in China. And it's right near all of those small exchanges, government-owned exchanges in Wuhan and in Shenzhen and places like that, Xi'an, where the government closed them down because they found they were actually not really exchanges, they were booking the trade. So now where do the customers go for this? Companies like retail brokerages, IBs of retail brokerages, which have got a prime of prime relationship that offers them all of those multi-asset classes on an OTC basis. Because they don't want just Chinese stocks or Alibaba or anything like that. It has to be fully multi-asset international stock. So I think that is now the requirement of most retail brokerages.
I think look, there's at every different sort of echelon of the market, there's some kind of arms race going on. So if you look at the retail end of the market, certainly the product list and the amount of products that a broker is able to offer is definitely one of the things that they would actively market themselves on. MT4 has certain limitations in that on that side of things, and so we'll see how MT5 how the MT5 revolution develops, and I'm sure that will over time will become very relevant in the multi-product story. I think at our tier of the market, the arms race is slightly different. Yes, there's the challenge to provide as many relevant products as possible to our client base, but I think there's also very much a technology element to it. So you do have some prime of prime, so to speak, who are essentially just offering a white label of third-party systems, or you have the slightly more sophisticated prime primes such as us, who are creating our own systems and actually genuinely creating bespoke added value solutions for clients. I think so. You said at the start that obviously there's an effort to try and provide as many different products to clients as possible. I think that applies both to actual underliers, so are you offering FX, bullion, indices, etc., but I think also to services. So I went on the record recently in saying that I feel as though in our tier of the market we have the most diversified range of product offerings of anybody in our tier of the market, because we have obviously all the products that we mentioned, so the brokerage service in FX, bullion, indices and commodities. But then we also have all the risk services that we're able to offer. We have the auto hedging services. We have the risk consultancy services. So really the direction that we're looking to go in is to bring out a suite of tools that really call upon the expertise that we have as a firm. So the very, very strong technology baseline that we have, and the understanding of risk management, and trying to use that to deliver relevant products that are tailored to the client base that we specialise in, which is largely the retail broker communities.
A meeting of minds is something very refreshing these days, especially when looking at the financial side of this business and not just the technology side in which my roots originate. That's right, and that's the thing that a lot of companies have been caught out by, is that even just because a prime of prime or a liquidity provider has a good quality prime brokerage relationship doesn't mean it might stay.
No,
because
indeed.
they keep checking all the time.
Yeah,
and
right.
if it seems that they want to pull back, they will. This has happened a few times recently, actually,
yes.
to quite a few companies.
Yeah.
And they have actually, we know this because we've been doing the research, but those particular companies have carried on as normal, even though the prime brokerage relationship is gone. So what that means is they've been rebooking the business.
Oh, right, exactly.
Now this goes on, and the regulators don't notice it because that's not part of the regulatory remit yet. It will be in MiFID 2, but not yet it's not, as long as there's no provable customer damage. But I think this is an appalling misuse of the word prime. So I wanted to see what your opinion. I've been around various industry conferences and societies recently where you see the word prime used, when I know for for absolute certain that there is no liquidity provider behind it.
Yeah.
So you've gone the hard yards, you've established a high quality hedge fund, you've got the technology in place, it's all in-house. This is not an easy business to establish and succeed in. What do you think about people who do that?
Oh, I'm always very hesitant to sort of throw spears at other people's businesses for fear of what comes around the corner, right, to my own. But look, it is true that there is a vast quantity of foreign exchange business that goes unreported, the market is unaware of, right, and that produces risks. Yes. And we have to manage those risks. That's all we can do. We have to make sure that we are not one of the people, left stranded when a January 2015 event happens. And we have to make sure that our customers aren't those others. So we need to perform the requisite level of due diligence on our customers, and indeed on our prime brokers. I mean, that's a two-way street as well. Okay, so I think in all of these things, as I say, I'm hesitant to, as I say, throw darts, but one has to be aware of and this is a risk management game.
Yes, it completely is.
And it is about surviving it. Totally.
Between you and the bank and the customer.
Exactly, and that's very common in the hedge fund space as well, particularly within systematic hedge fund investing. I mean, I often say to people that we are risk managers before we're asset managers. Yes. And that's the nature of the sort of hedge fund that we trade. So we're very used to that thought process.
Meeting today with Raj Sitlani, prime brokerage specialist. What I've noticed over the last few months in China, probably the last year, is that a lot of the brokerages there nowadays, and some of the IBs that want to become brokerages, are very concerned and interested in only working with FCA regulated companies, even though that doesn't help them in China. It's some kind of yardstick that they're using as a benchmark. Also, the London Stock Exchange website and the Companies House website is not blocked there, so they can get the regulatory, they can get some company information from that. The other thing is they're looking for direct market access like this, even if they want to B-book, because what they're doing then is using the actual price feeds and setting a genuine price and then B-booking on the price feed provided by the actual LP. That has become a very large thing in China. I think gone are the days now of really the broker against the customer there. That's a thing of the past now.
Absolutely, but again, we at IS Prime are not in the business of providing a price feed. I think if we give someone a price feed, it's for them to execute on, and not just use it for their own warehousing strategy. So the only way to get around that is to get a commitment from the client that all of the A-book flow or STP flow that they're going to do will come to us, and to do that we will impose pretty aggressive minimum charges, or not aggressive, minimum charges that make it difficult for them.
Right, so
not just STP airflow.
So if they B-book, for example, even though it's using the price feed, it would be it would be punitive for them to do so rather than actually execute direct to market.
Yeah,
I see.
Yeah,
interesting indeed.
Because I'm sure there are other providers out there who are willing to give a price feed out to all and sundry, but we're not really in the game of doing that. If, as I said, we want execution. That's the purpose of providing someone with a price feed.
That makes sense. That's quite refreshing to hear, actually. So that's excellent. We'd like to have, obviously, during the course of the day, have a good look at the operational side of the business, and we'll certainly be coming back to you, Raj, to have a look further within the actual company itself. Very nice to see you.
Likewise.
All the best. See you soon.
Thank you. Cheers.
Jonathan and I today catch up on how exactly a prime of prime works. London seems to be one of the if not the major centre of where to be for this particular, for retail brokerage to look towards, certainly.
I think one caveat to that is that there's obviously a lot of uncertainty around regulation at the minute.
MiFID 2 coming up in January.
MiFID 2 is an interesting one. Obviously, our impending exit from our European friends. It's difficult to know what effect that's going to have. I think there is, to some extent, a war on behalf of the regulators on retail FX, which is not always well guided, because I think that the more that a regulator tries to regulate let's say, a UK-based retail broker out of existence to try and protect the UK retail client base, in their view, the more it potentially does the opposite by driving that retail client base to offshore brokers.
Well,
because
yes,
ultimately,
that's right.
Ultimately, these are all internet-based businesses. So
That's why I don't think that's what their reasons are. That's what they said in about a year and a half ago, when the FCA sent out a circular saying they were going to look at changing the leverage and all of the trading conditions of CFDs because of customer interest. However, one of two things doesn't make sense. First of all, exactly as you say, this will push British customers who are used to a good quality environment to unregulated offshore brokerages who don't have their best interests in mind. The second thing is there are no complaints really against most of the household name retail CFD and FX providers in this country, and they have a very loyal client base. You only have to look at CMC Markets and IG Group and Hargreaves Lansdown. Hargreaves Lansdown, 100% of their customers are British, and it's a huge £6 billion company. IG Group and CMC Markets, about 80% of their clients are British, the rest are in France and Germany, and they are a loyal client base of educated traders. So therefore, what's the problem? The problem, in my opinion, is a lobby group by the exchange movement.
possibly. I mean, it's always a little bit difficult to sort of speculate what's going on in the background. I mean, I think what I definitely would completely unreservedly agree with is the fact that there can be very definitely a law of unintended consequences with over-regulating, and you do run the risk of ultimately creating a bad outcome for the very people that they're trying to protect. There is undoubtedly a very strong exchange lobby, I think, particularly in the States, and yes, and that is possibly the reason why the OTC FX market is in some degree of quagmire in the States.
Absolutely. I mean, if you look at even that has extended itself. IG Group, massive company, and has its own power in a way in the retail space. Nobody really wants to tread on the same patch as IG Group. However, if it really came down to it, who's going to win, them or the London Stock Exchange? You know?
Yeah.
So I think that's what I think is driving it. So it's one of those moot points with me. It sticks with me a bit that there are companies which are basically retail brokerages that nobody's ever heard of that operate from offshore or jurisdictions that you can't get access on because they are in the Asia Pacific region and there's no data on the internet, that hold themselves out as prime, and you can then, if you're a relatively new new retail brokerage, would see their terms as being very favourable, but really it's a retail feed. So in my opinion, you have to come to London or Sydney for these kinds of... Now, North America used to be the case, but it's becoming less and less so now because the landscape is more exchange-traded futures and things like that. That's where the technology investment is. That's where the majority of the trust is. But if you're going to, in my opinion, if you're going to have a prime of prime genuine relationship, it has to be in one of three jurisdictions: Australia, Britain, or the US, where there's only one left.
Is there really only one now?
Only one left, in my opinion. I think other regions there is no prime of prime.
Yes, that's probably right, isn't it? I mean, the US is an interesting one because where that goes, nobody knows, and there's all sorts of...
You have advanced markets, and that's about it.
But there is change afoot there, as I understand it, and a sort of slight retrenchment of regulation, etc. So that may change. But broadly, look, I agree with you. I might make a case for the UAE, I suppose. As well, I think yes, and you know, I think that's an environment that's looking to attract this sort of a business. Who knows? But broadly, what you're saying is true. For a retail brokerage business to contract with a sort of liquidity providing counterparty, one has to be extremely careful, given the risks that can be run. And there is they have a duty of care to perform due diligence on us as we do on them.
So there we have it. For the very first time in this industry, an in-depth look at prime of prime brokerage in London's prominent financial sector. Thank you very much for watching. See you next time.